Many people still dismiss cryptocurrency as a speculative gamble, something only for tech-savvy youngsters or reckless gamblers. But ignoring it completely could be a huge mistake, potentially costing you hundreds of thousands in future financial opportunities. Historically, major technological shifts like the internet or smartphones were met with similar skepticism, yet those who understood and adapted reaped immense benefits. By overlooking crypto, you might be voluntarily opting out of a significant evolution in global finance and technology, similar to dismissing email in the 90s, when 97% of households still relied on physical mail. This isn't about getting rich quick, but about staying informed. Let's be clear, cryptocurrency isn't just about Bitcoin or Dogecoin. It's an umbrella term for a vast ecosystem built on blockchain technology, which is fundamentally a secure, distributed ledger. Think of blockchain like a shared, tamper-proof Google Sheet that everyone can see but no single entity controls. This core innovation allows for transparent and immutable record-keeping, a game-changer for industries far beyond just digital money. The World Economic Forum estimates that blockchain could add $1.76 trillion in business value by 2030, impacting everything from supply chains to healthcare. Understanding this underlying tech is crucial, not just the price of a coin. At its heart, crypto promotes decentralization. This means moving power away from central authorities like banks and governments. When you use a traditional bank, they control your money, approve transactions, and can even freeze your accounts. With decentralized finance, or DeFi, you directly control your assets through secure digital wallets, acting as your own bank. This level of autonomy is unprecedented in modern financial history. For individuals living in regions with unstable economies or restrictive financial systems, DeFi offers a lifeline, allowing peer-to-peer transactions without intermediaries, cutting fees often by 80–90% compared to traditional international wire transfers. One of the most practical applications gaining traction is decentralized finance, or DeFi. Imagine earning interest on your savings at rates significantly higher than traditional banks, sometimes 5–10% APR on stablecoins, which are pegged to the US dollar. Platforms like Aave or Compound enable peer-to-peer lending and borrowing, creating a new financial infrastructure outside the conventional system. For instance, while your bank might offer 0.01% on savings, some DeFi protocols can offer 500 times that, a difference of thousands of dollars over a few years, allowing your money to work much harder for you without a traditional intermediary taking a cut. Another critical use case is remittances, sending money across borders. Traditional methods like Western Union can charge up to 7–10% in fees and take days to clear. Cryptocurrency, particularly stablecoins or even Bitcoin, allows for near-instantaneous transfers with fees often under 1%, regardless of geographical distance. This is a massive boon for migrant workers sending money home, potentially saving billions of dollars annually for those who need it most. For example, a worker sending $500 monthly could save $30.45 per month in fees, totaling over $360.40 per year, which is a significant sum for many families. Beyond finance, blockchain technology is revolutionizing data ownership and digital identity. Non-fungible tokens, or NFTs, are not just expensive JPEGs. They represent verifiable ownership of digital assets, from art to land deeds. Imagine holding your medical records or academic certificates as NFTs, securely owned by you and accessible only with your permission. This radically shifts power from large corporations to individuals, ensuring privacy and control over personal data, which in our increasingly digital world is becoming an incredibly valuable asset. This concept of digital sovereignty is a profound shift from the current model where platforms monetize your data. The Web3 movement is all about building a decentralized internet where users, not giant tech companies, own their data and control their online experience. Instead of logging into Google or Facebook, where your every click is tracked and monetized, Web3 applications would allow you to participate and even earn from the platforms you use. This could fundamentally alter business models, shifting billions in advertising revenue back to the creators and users themselves. Imagine a social media platform where you own your content and receive a share of ad revenue for your engagement, a stark contrast to today's extractive models. Now let's address the elephant in the room: volatility. Yes, crypto markets can swing wildly, with assets like Bitcoin experiencing 50% drops in a single year. This isn't a market for your emergency fund or money you can't afford to lose. However, understanding this volatility allows for strategic investing, similar to how seasoned investors navigate stock market dips. If you allocated just 1–2% of your total investment portfolio to diverse cryptocurrencies that align with your risk tolerance, the downside is limited, but the upside potential remains significant as the technology matures. Smart investing in crypto emphasizes dollar-cost averaging, just like with traditional index funds. Instead of trying to time the market, which is notoriously difficult, commit to investing a fixed amount regularly, say $50 or $100 every 2 weeks or month. This strategy smooths out price fluctuations, meaning you buy more when prices are low and less when they are high. Over time, dollar-cost averaging has been proven to outperform lump-sum investing for the average investor in volatile markets, reducing risk and building wealth systematically, even with assets as unpredictable as Bitcoin. Diversification is equally crucial. Don't put all your eggs in one basket, whether it's stocks or crypto. While Bitcoin and Ethereum are the largest and generally most established cryptocurrencies, explore other projects that have strong fundamentals and real-world utility. Researching projects in areas like DeFi, NFTs, or supply chain management can expose you to different growth vectors. Just like you wouldn't invest solely in a single company's stock, avoid single-coin concentration. A balanced approach could involve allocating 50% to Bitcoin, 30% to Ethereum, and 20% to promising altcoins, adjusting based on your research and risk appetite. The regulatory landscape for crypto is evolving rapidly, but this isn't necessarily a bad thing. Clearer regulations can bring mainstream adoption and legitimacy, attracting institutional investors and reducing market manipulation. Countries like El Salvador have adopted Bitcoin as legal tender, while others like the US and EU are working on comprehensive frameworks. This indicates a shift from outright skepticism to strategic integration. As regulations mature, the potential for crypto to become a more stable and widely accepted asset class increases, transforming its role from a niche investment to a foundational component of global finance. The potential for significant financial returns, while not guaranteed, remains a powerful draw. Early investors in Bitcoin, who bought just $100 worth in 2010, would be multimillionaires today. While those astronomical gains are unlikely now, new innovations and projects continue to emerge with substantial growth potential. Even a modest, well-researched investment of a few $100s today could see substantial appreciation over the next decade if the technology continues its adoption trajectory. This isn't a prediction, but an acknowledgement of the historical growth patterns seen in disruptive technologies. Think of it as digital gold, a hedge against inflation. Just like gold, Bitcoin has a finite supply. Exactly 21 million coins will ever exist, making it inherently scarce. In times of economic uncertainty or rampant government printing of money, like we've seen in recent years, traditional currencies lose purchasing power. Bitcoin, with its decentralized and fixed supply, can act as a store of value, preserving wealth against inflationary pressures. For instance, the US dollar has lost over 97% of its purchasing power since 1913, while Bitcoin has generally trended upwards over its lifetime, offering an alternative store of value. Learning about cryptocurrency also equips you with invaluable financial literacy for the future. Understanding blockchain, smart contracts, and tokenomics isn't just about investing. It's about comprehending the next generation of digital commerce and global systems. This knowledge will be increasingly relevant in job markets and entrepreneurial ventures. Studies show that individuals with higher financial literacy accumulate significantly more wealth over their lifetime, an average of $200,000 more than their less informed counterparts. Understanding crypto is part of modernizing your financial acumen, similar to learning about the internet in the 90s. How can you start? Begin by educating yourself. Follow reputable crypto educators, read white papers, and understand the basics of blockchain. Don't rely on social media influencers promising overnight riches. Sites like CoinMarketCap or CoinGecko provide vast amounts of data, while reputable news outlets like CoinDesk or The Block offer analysis. Think of it like researching a stock before you invest. Due diligence is paramount. Allocate 1–2 hours a week to learn the fundamentals for a month before even considering any investment. This small time commitment can save you from costly mistakes. Next, consider reputable exchanges for buying and selling. For beginners in the US, Coinbase or Kraken offer user-friendly interfaces and robust security features, though fees can be slightly higher. For more advanced users, Binance or KuCoin offer a wider range of altcoins and lower trading fees. Always ensure the exchange is regulated in your jurisdiction and has a strong track record of security, including two-factor authentication. Starting with a trusted platform minimizes the risk of scams or losing access to your funds, which is crucial when dealing with digital assets. Security is paramount in crypto. Once you own crypto, consider moving a significant portion from the exchange to a cold wallet, a hardware device like a ledger or Trezor. These devices store your private keys offline, making them virtually immune to online hacks. Think of it like moving cash from a bank account to a physical safe at home. It's more secure but requires personal responsibility. For example, exchanges can be hacked, as evidenced by the Mt. Gox incident where over $450 million worth of Bitcoin was stolen. Self-custody eliminates this exchange-related risk. Start small. Do not invest more than you are comfortable losing. A common recommendation for beginners is to allocate no more than 1–5% of your total investable assets to crypto. For someone with a $10,000 investment portfolio, this means a range of $100 to $500. This small allocation allows you to participate in the market's potential upside without jeopardizing your overall financial stability. It's an exploratory investment, not a core retirement strategy, at least not yet. This cautious approach mirrors the prudence you'd apply to any high-growth, high-risk asset class. Even if you decide against investing, simply understanding the technology is a crucial skill for the future. Blockchain is permeating industries from art to logistics, and having a foundational grasp of how it works will give you a competitive edge. It's like understanding how the internet works even if you don't build websites. It empowers you to navigate the digital world more effectively. The global blockchain market is projected to reach $163.8 billion by 2029, a clear indicator that this isn't just a niche phenomenon, but a transformative technology you need to be aware of. In conclusion, dismissing cryptocurrency entirely is akin to ignoring the early internet, a potentially costly oversight in the long run. By understanding its underlying technology, diverse applications, and inherent risks, you can make informed decisions for your financial future. Whether you choose to invest a small percentage or simply stay informed, acknowledging the ongoing financial and technological revolution is no longer optional. The world is changing rapidly, and staying financially literate means keeping an open mind to innovations that can empower you and protect your wealth in the decades to come. Don't be left behind. Start learning today.